The best companies in the world always have the best people in the world working for them. But finding the best people is only half the battle, whereas the other half is keeping those good employees. So today, I'll talk about how companies retain and reward their best employees. I'll go over a strategy that's used by some Fortune 500 corporations, but the strategy can also be used by small businesses. To begin, we've got a company, their employees, or typically top employees or executives, and then we have a big pool of money. We'll call this our long-term incentive pool. The company says to these employees, we're going to contribute to this pool of money, and you'll participate in this. However, before we just give you the money from this pool, we are going to draft an agreement, and you have to meet the terms. Specifically, you need to become vested. Now, when we look at the pool of money, this often consists of several different assets. It's not just cash. You might see cash in there, but you could also see stocks. A long-term incentive could be company equity. The company might say to a high-level executive, hey, you're so good that we're going to give you some equity in the company if you meet these terms. But a strategy that is frequently used and not that well understood is life insurance. So I'll cover this one in detail because when a company learns about it, the immediate reaction is, how come I was not told about this before? And why doesn't everyone do this? How it works is we've got a company and then an executive. Let's call this guy Executive Joe. An important note here is that Joe is the insured, meaning the life insurance policy is on his life, and when he dies, the life insurance benefit is paid out. Now, the company owns the life insurance policy, which means they control everything. The company makes the contributions, so Joe does not have to pay for anything. Cash value builds inside of the policy, and that cash value is part of the long-term incentive pool. The cash value is an asset on the company's balance sheet. Now, the death benefit is the actual life insurance benefit that is paid out when Joe eventually dies. Who's the beneficiary? In most cases, it's the company. The policy owner, who is the company, also names the beneficiary. With that said, it is not uncommon to see a lot of companies put in place what is called a split dollar arrangement. What this does is split some of the death benefit dollars, so a percentage or a fixed dollar amount can go to Joe's family if he were to pass. It's common to see many companies set this up where a multiple of an employee's salary goes to their beneficiary if they were to die. Now, how the agreement works is the company sets the terms. It could be anything. It could be a number of years, a certain age, or it can be performance-based. Let's pretend in this example, the company says to Joe, if you stay with us for 20 years, we will give you a $1 million payout. So Joe needs to agree to this upfront. If he stays for 20 years, he becomes vested in the plan, and then at the end of the 20-year period, he gets his $1 million. Now that $1 million could be paid out as a lump sum, or it could be paid out over several years. That's typically defined up front, and some companies build in options as well. So here's how it works. The company is going to take that $1 million, but they're going to take it from the cash value of the life insurance policy. And they can take it through a policy loan, which they are not required to pay back, and because it's a policy loan, that is tax-free to the company. Now for Joe, he gets that $1 million, but it's given to him in the form of cash, meaning the company takes the $1 million loan, it hits their bank account, then they take the money from their bank account and put it into Joe's bank account. So he gets $1 million in cash, but that's going to be taxable to him as ordinary income. So that's how it works from a taxation standpoint. But here's the long-term incentive, and this is why so many companies have done this for a long time and continue to do this. So for Joe, eventually he's going to die. When he does, there is still going to be life insurance in force, and that life insurance benefit is paid out. The company is the beneficiary. Because it's a life insurance policy, that death benefit is paid out 100% income tax-free. And that death benefit is then used by the company for whatever they want, but in most cases, they'll use it to recover costs. And what that means is many companies will look at this as a means to recover all of the contributions they had made to this plan and also account for inflation, which is nice. So at a high level, that's how this works. However, a question comes up quite a bit, which is, what if Joe quits? Say this is a 20-year plan like we mentioned, and 5 years in, he says, hey, I quit. I'm going to go start my own company. I can make way more than $1 million. The company says, all the best. So he leaves. What does the company now do with the life insurance policy? They could keep it on him. That's an option, but most companies don't. Most will transfer the policy. And this is not a 1035 exchange. This is referred to as a transfer of insured. What we're doing is transferring the policy to Joe's replacement, the new executive that fills his shoes. This is actually very common in the professional sports industry, where you have a lot of highly compensated people who are very talented, but you also have a lot of turnover. So if you have an executive or a star quarterback at your ball club that you're paying $20 million per year, and you have one of these policies on them, and they're traded or they leave for whatever reason, what do? Well, you don't want to keep that policy on them because they're no longer working for you. You don't want to start a brand new policy on the next replacement that comes in. You can take that old policy that you, the company, own and transfer it to the new replacement. That allows the cash value to continue to compound at a fast rate, and you also have a life insurance benefit on this new employee as well. Let's take a look at how it works. So here's an example. What we've got here is a 38-year-old employee. He makes about $100,000 per year. We can see how much the company is contributing to the plan per year, $25,000 per year for 10 years, a total of $250,000. You can see the cash value build up over time, and that is money that is an asset on the company's balance sheet. They have access to that, and they can use it anytime they want. They also have life insurance on him. The initial benefit is $850,000. If they say this employee has been very loyal to us, if he dies, we don't want his family to be left with nothing. So they could implement that split dollar arrangement where they could carve out, call it 2x his salary, to be paid to his family if he were to die early, before the age of 65. So how that would work in this case is you have a death benefit of $850,000. If his salary is $100,000, he dies, and the agreement is that 2x of his salary is paid to his beneficiaries, then $200K goes to his family, and the remaining $650,000 goes to the company. Now, in this example, the company is paying him at age 65, and the benefit is a lump sum payment of $250,000. So the company would take this $250,000 as either a withdrawal or a policy loan against the life insurance policy. That way it hits their bank account tax-free. But then when they give that $250,000 to the employee, that's in the form of cash, and it is taxable as ordinary income to him. What do you notice as the years pass? Look at age 85. The cash value recovers, but look at the death benefit. It's $1.5 million. So if he passes at 85 years old, they get that $1.5 million back. So if you're the company here, what did you just do? You put $250,000 into the plan, you took $250,000 out and compensated your employee who served you up until the day he retired. Then, when he eventually passed many years later, you got another $1.5 million back, and it was all income tax-free because it's a life insurance policy. This is an example of a younger individual who had a longer runway. Here's another example of someone in their mid-50s. The funding period is shorter. We see it's $50K per year for 5 years, so the same $250. And the vesting terms could require that she needs to stay with the company until 65, but she gets the benefit at age 70. You can customize them like this, which is nice, meaning she does not have to work up until the age of 70 if she doesn't want to do that. We've got the same thing. If you're the company, you paid $250, you pulled $250 out. At 70, you've got more than $190,000 left in cash value, and the death benefit is worth more than $320,000. If we go down to age 85, the cash value is worth just about $400,000, and the death benefit is getting close to $470,000 that again flows back to the company income tax-free. What this does for companies is it allows them to create a long-term incentive pool that retains their top talent because they're incentivized to stay, and then rewards them on the back end with a large monetary benefit. At the same time, it creates a cash flow machine for the actual business because they've got that cash value compounding. They can access it tax-free like their own bank or like their own line of credit. And then when the employees eventually pass, the death benefits are still intact, which all flow back to the company income tax-free. It's very interesting, isn't it? So this is a strategy that has been used by companies for more than 100 years. But with that said, if this is something that you like learning about and you'd like to learn more or see specific case studies in terms of how companies do this, how families do this on a similar level, I'd love to know. Please drop a comment below and I can certainly create some case studies that provide more detail on this. Thanks again so much for watching, and as always, I hope this helps.